So investors have this saying that goes like this: don't fight the Fed. And basically what it means is that Jerome Powell, the printer Powell, has been playing with a game shark this entire time, and he just turned on the infinite QE glitch. Actually, it's because the Federal Reserve has been committed to buying up every asset class to bolster and to boost the economy and the stock market. And because of that, and a few other reasons that we'll discuss in the video, is the reason why we have officially begun the bull market. Or have we? By the standards of the S&P 500 index, we experienced the best 50 trading days of all time. So by that standard, we kind of have. But let me show you my dividend portfolio just to show you what's recently happened, because it's crazy. So in the past week alone, we have a 7% gain. And in the last month, 12%, double digits for a dividend portfolio. That's like seeing your grandma run a marathon. Something is wrong. This is like Tesla numbers right here. In the last 90 days, 3 months, almost a 10% gain. And in the last 1 year, after everything that's happened, the start of this horrible decade, we have 1.59%, which is still in the positive. But how can that be and why? It's an illusion, I tell you. Like this clearly empty suitcase right here. Hi, my name is Andrei Jikh. Hope you're doing really well, and there's a lot to discuss, so let's just dive right into it, and I'll show you exactly why the market is going so much higher. This is really important for me to understand, not necessarily because it informs how I should invest, but it does help me stay ahead of the curve by managing my expectations and my emotions so that I kind of know what's coming. Now let's take a look at these stock market indexes, the three major ones that are responsible for what's going on. They're made up of the S&P 500, the Dow Jones, and the Nasdaq. These guys track the overall performance of the stock market, but together they're not the stock market. They are not the economy, but they do represent a small piece of the giant millennium puzzle that is the economy that, legend has it, Jikh is still trying to solve. Poor guy. Now, the Nasdaq index is the second largest index that tracks the market, and it represents around a $10 trillion market cap from about 3,500 stocks. It's huge. But it's also the reason we're told right now from the media that the new bull market and the new bull run is here. But if you're asking yourself whether or not you should start investing based on indexes alone, which is what we're being told, then consider the fact that the Nasdaq is very heavily overrepresented by health and tech. More importantly, the tech sector represents almost 50% of the entire index. However, the tech sector is not the stock market, nor is it the economy. It's just a piece of it. So even though it's not the majority, it still represents a big part of that index, which is almost not fair. Insert something subtle and clever about social dynamics here. Meanwhile, the S&P 500, which tracks the top 500 companies in the US, is my favorite, and it just experienced the top 50 trading days of all time, smashing the previous record set in 1982 when we gained 35.6% in comparison to 2020's 39.6%. That kind of growth just doesn't make sense and can only be compared to my YouTube channel. No, I'm kidding. I'm just getting desperate to get to 1 million before the end of the year. Please subscribe. And the last one we have is the Dow Jones. And the best way to describe that index is kind of like your appendix. It's just there. I'm not sure why we have it. It only has 30 companies inside of it, and they're not necessarily the biggest companies. We've just kind of had it for a long time now, and it just exists now, but I don't think we need it. And it is 2,000 points away from hitting its all-time high. Now, the prices of these top three indexes reflect what the United States might look like 12 to 18 months from now. And it's predicting and pricing in perfection. Just perfect. Everything's gonna be great. A swift vaccine, a swift recovery of jobs, and not at all a second wave of the Llorona, which we all know, if it hits us in the wintertime again and causes a second wave of shutdowns, will completely wipe away all market gains. And right now, if you're asking yourself how much money to invest, that's something to consider because the stock market is not pricing that in yet. But let's say you are starting to invest and you lose money. It happens to all of us. But let me show you something that's really fascinating that most people don't even consider. It's really cool. Let's say you have $100 of stock X, right? And you lose 50%. Well, then in that case, your money is now worth half, right? Don't worry, I've got plenty more of these. prop monies, not real hundreds. So now you've lost 50%, but then the market decides to come back up and recover 50%. Naturally, our minds think, oh, well, if I've lost 50 and I've gained 50, now I'm back to 100. But that is not at all what happens, because when you lose 50% of your initial investment and you gain back 50%, you only gain back 50 or half of whatever you have, which in this case, you only have 50. So you only gain back exactly 25, in this case, $25 added to your original 50. So now when you lose 50% and gain 50%, you're not back to where you started at 100. You're back to 75, so you're still down $25. It's a weird thing to wrap your head about, but let me show you exactly how many percents you need to gain back after losing in a hypothetical $1,000 investment. It's really cool. Check this out. At a loss of 10%, which leaves you at $900, you need to gain 11% to get you up to $1,000. At a 20% loss, $800, that needs a 25% recovery to get back to $1,000. At a 30% loss, $700 left, a 43% gain to break even. At a 40% loss, $600 left, which is a 67% recovery to equilibrium. And a 50% loss leaves you at $500, in which case you need to double your money 100% to get back to 1,000. But after that initial 50% is lost, it becomes crazier and crazier, and you need a higher percent to the point where it's almost impossible, and your initial investment may never get back to its original value, which is why it's very important that you pay attention and make sure that your investments don't lose much more than 50%. Like I have done in the past. And I will, because I'm a human and I will make mistakes. And you probably will too. High five, Gypsy. It's nothing to be proud of, but it's all right. Life. Now, I'm not trying to scare you, but hopefully you understand that by sitting out of the market because you lost some money and now you're scared and you're gonna wait until you see a recovery, it becomes increasingly more difficult to see another, say, 50% recovery because one just happened and you weren't in it, which is why I always say that by missing out on the top 10 trading days, you could miss out on as much as 50% or more of stock market returns averaging out over the last 20 years, because the stock market can move so quickly, kind of like what's happening right now. But what's important to understand about the market, though, is that it's a forward-thinking machine, in that it adjusts according to what it anticipates will happen 12 to 18 months from now, but then reality often follows it. It's almost like Skynet, and it's amazing at just how darn good of a job it can do in trying to predict the future. It's almost like
it's irrevocably, indubitably, and has become exceedingly efficient at it. Yes, I am the architect from the Matrix. Smash the like button.
I'm sorry, I really like that movie, but let me explain exactly what I mean. So let's use the elections. I'm not gonna get political, I'm just gonna use politics to prove something really cool. So check this out. The elections can't really prove where the stock market is gonna go, but the stock market can act like a crystal ball in predicting who the next president will be 3 months before it happens. It's super cool data from LPL Research. Check this out. If the S&P 500 index, aka the top 500 companies in the United States, aka VOO on Robinhood, if it's green 3 months before November elections, then there's a good chance that the incumbent party, or the party that's in power right now, will remain in power. But if VOO is red 3 months before it happens, before November, then there's a good chance that there will be a shift in power. In fact, 20 out of the past 23 elections have been correctly predicted by the stock market 3 months before they happened. That means there's an 87% chance that we'll know exactly who the next president of the USA will be starting around August to September time. So if we see stocks that are in the green in the last 3 months of the presidential election, then we'll most likely see 4 more years of the same. And if we see red in the stock market, then we will most likely see a change in the political power to the Democrats. I'm so excited to come back to this video to see if this is accurate, so please just comment down below and let's remind ourselves to come back after the elections to see if this data was accurate. But here's another reality to consider. We've lost over 100,000 people to the illness. Over 40 million people are still unemployed. Those are numbers that rival the Great Depression. We have protests, we have riots, we have civil unrest, and yet none of those things have affected the stock market nor investing. It's a little strange because you would think if you're trying to reopen the economy, that would lead to more job losses because of fear, which would ultimately lead to a worse stock market. You would think. But that's not what happened, which is why I always say that every time a lot of people agree on something unanimously about the market, things will almost always go the exact opposite way of how people expect them to go. This is called the herd mentality, and you want to stay away and you want to try to think like a contrarian. Remember, the stock market is forward thinking. It tries to predict where things are going to go, and nobody in their right mind, including me, ever thought that anytime soon we would see any kind of job recoveries. But that's exactly what happened, and the stock market did its job. It forward thunk correctly, and we recovered 2.5 million jobs, which is pretty much the most on record. Of course, this could change at any moment, but so far, the herd was wrong. All of this echoes the video I made called "The Stock Market is About to Explode," where I thought that the market would go way higher in the short term, and that's exactly what happened. But did you miss the rally? And if you have $100 or $1,000 to invest, or maybe even $1 because you got access to Robinhood's fractional shares and you got your free stonks from Robinhood and Webull, then should you invest right now or should you wait for what's going to happen? So here's the answer. The most important thing to remember is that you're about to watch a total stranger make an attempt at predicting the stock market whose financial goals and motivations you are completely unaware of. So what are you doing with your life? Don't listen to YouTubers, including this one. And two, here's how I look at it. I always look up to smarter people than myself, the ultimate value investors, Charlie Munger and Warren Buffett. And what they did was completely wrong. All they had to do was just stick to their ultimate investing philosophy of buy and hold long term, and instead, they would have saved themselves and their investors billions and billions of dollars. All they had to do was hold on just a little bit longer. United Airlines alone gained 11.1%, which is insane. Warren Buffett 2020. Buy high, sell low. But Warren Buffett is not alone in making that mistake, because I've seen people, even here on YouTube, sell most of their stocks just because they anticipate the stock market will drop lower because of what's called dumb money, which is just an influx of new investors that saw the market go up and they got FOMO, the fear of missing out. So they've got weak hands, which means they probably do stupid magic tricks too. But it also means that if the stock market goes lower, they're going to just sell everything, and that's what's going to crash the market. And that is incredibly short-sighted and wrong. And here's why. Most investors in the stock market are considered institutional investors, which are much more sophisticated, and they own at least 80% of the stock market. So whenever people say millennials or weak hands will crash the market, it's completely wrong, because we own no more than 20% of the stock market, and the rest are large corporations and other entities that participate in corporate buybacks to drive up their own stock prices. Ultimately though, the odds of you getting in and out of the market and correctly predicting it are actually not that bad. It's literally 50-50, like flipping a coin. But if you get it right once, that's possible. Getting it right twice is improbable. Getting it right 3 times is almost impossible. And I don't mean that literally, but I'm just saying the more times you flip a coin, even though it's still 50-50, the more you try to flip the coin and guess the sequence, the more impossible it starts to become. Which is why I don't deviate from my buy and hold long-term boring dividend strategy, no matter and regardless of what Warren Buffett is doing, regardless of what the news media is telling us, and regardless what any YouTuber is doing. If you really want to start investing, but if you haven't yet, you can get 3 free stocks, 2 from Webull, by creating your free account. The first one valued up to $250, but if you fund your account $100, you can get another free stock valued up to $1,400. Your third free stock from Robinhood, and that's 3 free stocks. Go get them while they are still offering them. Love you all. Thank you so much. Follow me on Instagram if you want. I post there from time to time. Post here on Monday and Friday. Would love to have you back. And in the meantime, stay safe. Be careful out there. We're going to get through this. Everything's going to be all right. Love you. Bye-bye.